volatility tends to cluster. So when volatility emerges, it tends to cluster. When it clusters like this, returns tend to be bad, so we should cut risk. So on a simple basis, if vol doubles, we should cut risk in half, and then we look about the same. So you probably have seen funds that target a 10 vol, flat vol. All they're going to do is modulate their position based on moves in vol. Now, we do it on a slow and fast basis, a 1-year basis and a 12-day basis, similar to when you see the VIX go kind of, front month VIX go steep over back month. People like to buy tail hedges, cut risk. This is kind of similar. When short-dated realized vol picks up quickly, we'll cut risk more quickly. And what that does for your portfolio, what you kind of care about are these two things. One, so this line is kind of a theoretical portfolio that's never constrained by any kind of vol. What it does for your Sharpe ratio is basically you're cutting vol of your portfolio. If, in fact, we're right that you're missing some of the worst periods in the market, your Sharpe ratio should get better, and it does. And if we're right that risk will be diminished by doing this, then your mean shortfall should be better. So in both cases, they're all better. A few things that might be interesting is that vol scaling hasn't worked historically in bonds, so people don't tend to do it in bonds. This is the first year it would have worked in bonds, because when vol picks up in equities, usually bonds rally. So one study we've been running, which we lack data because it doesn't happen, is whether vol scaling works when bonds are going down. We're using 1970s data, but unfortunately we're just kind of confirmation bias that you should be short bonds when they go down.